Hello and welcome back to Managerial Accounting, Chapter 11, Reporting for Control. This is our last video of this chapter, and we're going to be looking at the balanced scorecard. So in previous chapters, previous learning objectives, in the last video, we talked about return on investment, and that is a financial metric. However, we have many different aspects, and perhaps we shouldn't just be evaluating management based on one perspective, the financial perspective. That's where the balanced scorecard comes into play. The balanced scorecard allows for management to really translate, as it says on the screen, their strategy into various performance metrics that help everybody become aligned with their role and how it works to the corporate goal. And so there's four aspects: financial, internal business process, customers, and learning and growth. The balanced scorecard is designed so that if one of those performance measures improves, then the desired performance of the overall company improves as well. And so the balanced scorecard has measures, or should have measures, that are linked together because of cause and effect results. That is, the balanced scorecard lays out concrete actions to attain the desired outcomes. So for example, if you are floor in shop employee and you are making, let's say, t-shirts, if you improve your business processes such that you reduce the amount of waste, that should be something that you are rewarded for. And overall, that saves the company money. So it's win-win when you look at it through the various perspectives on the balanced scorecard. All right, so the balanced scorecard, as I mentioned, relies on financial and non-financial measures for two reasons. The first is that financial measures tend to be lag indicators that summarize the results of past actions, whereas non-financial measures can be, if you select them wisely, leading indicators of future financial performance. That is, it's more tied closely to what has been done this month, this week, this year, than perhaps what is reflected in our financial numbers. Friendly reminder that top managers are ordinarily responsible for financial performance measures, but not necessarily lower level managers. Non-financial measures are more likely to be understood and controlled by those low-level managers, meaning that everybody will be more bought in to how their performance translates to overall corporate success. The entire organization should have an overall balanced scorecard, and each individual should have a personalized balanced scorecard. That personal scorecard should contain measures that can be influenced by that individual being evaluated and support the measures in the overall balanced scorecard. Then, incentive compensation for employees should be linked to that balanced scorecard performance measures. This should only be done after the organization has successfully managed with the scorecard for a period of time. The emphasis on this balanced scorecard is on progress and improvement rather than on meeting a specific standard. So let's zoom out and take a look at what an example of this would look like. All right, so here we have what is referred to as a simplified strategy map. While it might look quite involved, it is a simplified version. My friend, I think I mentioned this previously, worked at Nexus in Calgary, and part of their business process mapping, where they looked at activity-based costing. I believe a year or two later, they did something similar with their balanced scorecard. So again, lots of poster paper, lots of sticky notes, lots of people, and lots of ways to see, hey, how can we translate this overall corporate strategy to the individual managers and to their individual staff? All right, so let's take a look at the financial. Okay, so what does the company want overall? Lower costs and increased revenue. That, yep, will go to increase profitability. What is our measure going to be? Market value, seat revenue, plane lease cost when we're looking at a regional airline. So what are our targets? We want to improve our market value by 25%. We want to increase our seat revenue by 20%. And we want to reduce our plane lease cost by 5%. And so what are we going to do? We're going to try to optimize routes and standardize planes. Cool. Financial. Let's look at, I'm not going to go through all of them, so let's look at one of these. Let's look at internal, let's look at learning. So learning and growth is How do we align the ground crews? So what is the percentage of ground crews that are also shareholders? And what percentage of ground crews are trained? Okay. So in year one, we want to have a target of 70%. By the time we have fourth year employees, 90%. And by the time employees are maybe in their sixth year, or maybe this refers to in 6 years, we want 100% of our ground crews to be shareholders, and to be trained. Yeah, absolutely. I want lots of, maybe they mean cross-trained with other ground crew. So I would like that cross training, 100%, and shareholders such that they're aligned, their objectives are aligned with the corporation's objectives. So how we're going to do that, we're going to implement some training, and we're going to have a stock ownership plan where the ground crew, perhaps all employees, receive a discount on shares available. So really help incentivize the crew to meet their goals and therefore meet company objectives. Okay. So the corporate social responsibility really does overlap nicely, or can, should a company choose to, with the balanced scorecard. Companies are responsible for creating strategies that produce financial results that satisfy shareholders. They also have corporate social responsibility, CSR, to serve other stakeholders whose interests are tied to the company's performance. So those might be residents of a community, those might be the environment as a whole, the customers, as well as our suppliers. So CSR is a concept whereby organizations consider the needs of all of those stakeholders when making decisions. And this often extends well beyond legal compliance to include voluntary actions that satisfy stakeholder expectations. Nowadays, the CSR, corporate social responsibility, tends to be aligned more with profits for the simple reason of social media. If a company is seen to be acting against the community, that would be put on blast, put on notice by social media, and oftentimes people will call for boycotts of certain companies if they find that that company is not, acting in line with the community's best interest. So balanced scorecard can be a way to ensure that the different employees of the company are acting in a way that balances CSR and as well as other company objectives. And it's a way to kind of integrate everything. But that being said, it also could have really real financial as well as non-financial impacts if a company doesn't act within CSR guidelines. All right, that's it for this chapter 11 on reporting for control. Some items that we've covered today are segmented income statements. These provide information for evaluating the profitability and performance of divisions, product lines, sales territories, whatever the company chooses to segment. Under the contribution margin, those variable costs and fixed costs are clearly distinguished from one another. However, only the costs that are traceable to a segment are assigned to that segment. Otherwise, they're known as common fixed costs. A responsibility center is going to be a segment of the organization whose manager has control over and is accountable for cost, profit, or investments. A cost center is a business segment whose manager has control over costs only. A profit center is a segment whose managers control revenues and costs, but not investments in operating assets. Whereas an investment center manager controls profits, so revenues, costs, as well as investments in those operating assets. The return on investment can be used to evaluate investment center performance because it's like, hey, how well are you doing utilizing the assets under your control? Okay. And the balanced scorecard consists of financial and non-financial performance measures that are integrated into a system of overall comprehensive performance measures that are derived from and support the company's strategy. There are 4 main perspectives of performance measures within that balanced scorecard. You have financial, customer, internal business processes, and learning and growth. Different companies have different balanced scorecards because they have different strategies. Organizations are increasingly including social and environmental performance measures in their balanced scorecards, and some of them might report and refer to them as sustainability scorecards. People, thank you so much for your time and attention. We have one more chapter left after this, so please, friendly reminder to utilize your resources available. Come see us during office hours. Use the discussion boards. Practice, practice, practice. And I will see you in the next and last chapter. Talk soon.